Good morning.
Good morning, James.
Thank you very much for doing this. Mobius, interesting fund, and obviously been doing very well last year. And I think you've got your 3-year numbers now, which is incredible how quickly these things happen. But so you can tell us a little bit about the fund and what it's trying to achieve, please.
Yes, thank you very much. A great pleasure to be invited today. Well, we set up on this journey almost 4 years ago now. And our goal was and is to generate sustainable outsized returns in emerging and frontier markets. And we do this by very careful stock selection. And we also do this by actively engaging with portfolio companies in order to help them to address certain shortcomings on transparency, on ESG-related matters, and in the best case, sort of kickstart a development which is really a process whereby companies embrace and improve their ESG strategy. But it's really stock picking, which is at the center of what we do. And it is a highly differentiated offering. We have a, if you look at some of the largest trusts and funds out there giving access to emerging markets, many of them really focus on the large caps, and they have a relatively low tracking error and a very low active share. We have said right from the beginning, we wanted to give access to a segment which we find most exciting in emerging markets. And these are medium-sized companies run by entrepreneurs and families. We also are very excited about some of the larger changes and developments which are taking place in emerging markets, especially around the subject of technology and innovation, but also healthcare and general consumer trends. So there, for example, there's a big trend towards more sustainable and more localized consumer products and brands. On the healthcare side, there's never before been a time in emerging markets where emerging market families and consumers had more money to spend on healthcare related services and products. And in technology, there's never been a time before where emerging market based companies, obviously mainly in Asia, but also many other parts of the world, are beginning to dominate in terms of intellectual property, innovation, patents, and solutions which cater to some of the most interesting areas, including crypto technology, including, of course, autonomous driving, Internet of Things, etc. So many of these idea factories really sit in emerging markets, and many of these companies remain relatively small. So, as you said, we had a very strong return since inception. We've outperformed the peer group. We've outperformed the benchmark. We generated over 58% in absolute returns over those 3.5 years without actually too much risk here. We've actually had a very benign and positive risk profile with low volatility and lower drawdowns. And we are a small, very aligned team. We've got a lot of local expertise, a very strong network, which helps us to find ideas. We've got a very strong pipeline of new ideas, which is coming through our investment process, and many of the relationships which we built in emerging markets over the past 20, 30 years. And we are, it's important to us that we stay small. So our maximum capacity is around $2 billion. We are now getting closer to 400 million. But that size and that focus allows us to do what we want to do. Just carrying on, thank you, James, for sharing the slides here. Just to cover the edge of what we do and also emphasize some of the factors which make this strategy very different. So first of all, we focus on a single strategy. We said from the beginning, and past experience has taught us many lessons. When a team focuses on too many strategies at the same time, typically the outcome, the result suffers by doing so. So we said, let's focus on one single strategy only. utilize our vast network in emerging and frontier markets to generate ideas, to build relationships, or to build on existing relationships in order to find the most talented people, the most talented entrepreneurs in emerging markets, which are acting as sort of magnets of other talents, which are joining these business models. And we've got a very, very rigorous focus on quality, especially when you navigate in medium-sized companies. Of course, you need to be very careful about risks you're taking. We don't invest in businesses which have excessive leverage. We don't invest in loss-making companies. We don't invest in companies which have sort of a volatile operating performance over the past years with, sort of also accounting issues or any irregularities which are sort of red flags. We look at stable operators, compounders. We look at companies which are, as I said, blessed by the fact that they can attract some of the best talents in the respective industry. We love brands, we love IP, we love companies that secure their business and can generate and develop unique technology around their business, around their products and services. We also strongly believe in concentrated portfolios in general. Our past history has shown that there's an ideal sweet spot for, I guess, not just us, but most managers. So anything beyond 30 investments, you typically dilute results and you no longer gain from further diversification. So we are looking at 25 to 30 outstanding businesses. So that's fairly concentrated. Most of the EM funds out there are somewhere around between 70, 80 and 120 stocks. And we've got quite a bit of our own savings invested here. So we are partners with our own investors. And the thing we believe most in, especially in today's sort of day and age where sell side is no longer well resourced, where there are many sort of more unorthodox information sources available, primary research is more important than ever before. Due diligence and a very deep investigative process is more important than ever before. And that allows us to uncover some of the most unique business models we can find. And of course, especially in Asia, but first and foremost in China, data is still unstable, to use a friendly word. And you have to be ultra careful before you invest in places like that, where accounting standards are still lagging behind in terms of quality. If you look at the portfolio positioning and some of the companies, just one more point on the profile of the kind of companies we're investing in, that is on slide 6. Sustainable competitive advantages, as I mentioned, modes are very important to us. Expanding industry profit pools, so we like businesses which see strong tailwinds. Of course, we love growing businesses. We don't like incumbents who have to defend their businesses against disruptors. We rather look for disruptors themselves. And also on the engagement side, it's not that we desperately look for engagement opportunities, but when we see engagement opportunities, which is the case for most of the investments we're conducting, we take them on and we help companies to improve their transparency, to address suboptimal board compositions, to help companies become better in what they do, also in communications, but also, for example, with regards to the wider ESG framework, we can help companies in many ways if they show willingness to do the homework for obtaining a better ESG rating. We certainly avoid the financial sector, which is overly populated, highly competitive. We don't like commodities, conglomerates, the large telecom businesses. These are all very mature businesses. These are all companies of the past, and really focus on innovation. If you look at some of the sources of alpha, we love to say that the majority of our outperformance really has come from that ability to identify these opportunities. But it's also partially the work which is done by companies, often initiated by us, inspired by many of the ideas which we share with management teams, where they, over the past 3-4 years, have gradually been recognized for their work to improve governance, social aspects, environmental aspects. Many companies have really taken on these subjects in a very serious fashion. So we've seen companies extending, for example, insurance policies to families, to parents of employees. We've seen companies for the first time disclosing how they deal with wastewater. We've seen companies reporting a full 360-degree environmental report. So all of this is taken positively by the market. And it's early days, and we are convinced that as these companies will obtain decent and improving ESG ratings, that translates into attracting more shareholders and is typically seen and liked by the market. So there's another push for re-rating coming from that source. Our process is now really time-tested and a very robust process. It's based on repeatable activity, and we constantly want to ensure that we use that process to find yet the next exciting opportunity in emerging and frontier markets. And really the core focus is on our proprietary internal investigative due diligence process, which we conduct, which takes as often as long as 3-4 months per company. Yeah, I talked about the performance. It's been an interesting ride in emerging markets. There's never a quiet day. As we can see currently this week again, emerging markets continue to be very much impacted by the global sentiment, by lots of risk factors. And it's been like this basically forever, but it was no different over the last 3.5 years, from volatility in the Middle East, volatility coming from developed markets, tension which came from the Trump administration impacting global markets, all the way to the current situation, where again we're looking at a global confidence crisis. And all of this is happening while interest rates are increasing, cost of financing is increasing, also, of course, causing lots of uncertainty. There's no evidence that higher rates in the US will impact emerging market performance negatively. In most of the previous rate hike cycles, emerging markets outperformed, and we see lots of reasons why they can, and we see lots of reasons why they should, because they diversified their funding sources and they're no longer entirely dependent on the Fed. We've outperformed the MSCI Emerging Market Mid-Cap Total Return Index by over 30% since inception, which makes us one of the, if not the best performing fund in its class. Last year was very good. The year before was very good. So we continue to think that this kind of highly differentiated strategy with a very high active share can deliver differentiated returns.
Can you explain what sort of time period do you think people should be looking at your returns over? Because obviously, given that you're concentrated portfolio, you're not kind of matching the market, you won't always perform in line with the index. What's the sort of reasonable time frame?
Well, we look at, I think the best thing is to align sort of the expectation of our investors with the way that we work and the way our process is organized. And we typically look at 5 to 7 years. So when we look at, for example, valuations of businesses, we always look at the 5-year forward value that we are interested in. Of course, we are looking at companies which are going through transformation processes. They're expanding vertically and horizontally. They're changing their revenue and profit streams, and they are in that transformative moment where they can multiply in size, where they should multiply in size. So it's the long term that we are interested in. We don't trade much. We don't try to optimize things over the short term. So really 5 to 7 years, I would say.
Cool. You had a couple of examples of things that have been driving returns here.
Yeah, the nice thing, James, is that the returns came from stock picking, and the outperformance can be attributed to by 80% to really the stock picking activity. We've outperformed in almost every single market. We haven't done so well in Russia, where we exited early enough, but still that had a slightly negative impact on the performance. Brazil had a tough year last year at least, but it's beginning to recover very, very strongly this year. The main drivers for the excellent performance were India and Taiwan, also strong stock picking in Korea, very good stock picking in Southeastern Europe, and as well as Africa, where we have 2 holdings. Both have done very well. And the drivers were technology, a company like eMemory, which is directly exposed to the exploding need for encryption technology, not just by cryptocurrencies, but by essentially every single consumer good which has a semiconductor contents. In addition to that, our Indian holdings, like which are a balance of export-oriented and domestically exposed businesses, both have done really well. And we continue to think India is something you can take into hibernation for a while. The Indian government is extremely focused on supporting and ensuring that the economy can grow and attract capital. They're investing another $200 billion for the coming years. The economy is growing by over 9% for the foreseeable future, not just this year, but also next. And you've got this meeting, one of the most talented pool of talents in emerging markets. So lots of really exciting businesses here. Persistent Systems is one example, which is an IT consulting firm competing globally, specializing on sectors like healthcare, offering turnkey solutions, fully integrated IT solutions for hospitals, for example. And they've been very successful over the past couple of years, and they will continue to succeed as they are winning new clients globally. So we've been very selective. We've been very careful to search for these champions. Another 2 good examples mentioning here is a tech business in Kenya, where we have invested in the leading mobile money service provider, but also in South Africa, which certainly is challenged macro-wise, but we invested in a business which can do well in any scenario, which is the leading pharmaceutical chain, pharmacy chain, offline and online in South Africa. So in terms of the allocation, as you can see here, so we're dominated by Asia. This is really an Asia strategy. I would say Asia plus India, over 25%, Taiwan, then China, where we are really cautious and careful, mainly going via Hong Kong. We've sold, we had a direct investment in China in an orthopedic implant business where we had a super strong return and sold at our exit multiple last year. And then South Korea as well as Vietnam, Malaysia, and the rest is then outside of Asia, Brazil, South Africa, as I mentioned, Kenya. In terms of sectors, James, we are increasingly specializing as we learn more and more, and as we spend more and more research hours understanding this never standing still space of technology. But it's a highly differentiated focus. No Alibaba, Tencent, Samsung, SK Hynix. We are diving deeply down to tech leaders in niches. And globally, we're also looking at software. We think that software is something where emerging markets will invest tremendous amounts of capital into, and local software leaders. And that is something which we're observing everywhere. As the digital migration is speeding up even faster, as companies need to embrace the digital transformation, more and more software content is needed. And the rest is then industrials, healthcare, and consumer oriented.
So you said you had something in Russia, but you sold it. So you're not really exposed to the Russian-Ukrainian situation. Is that true?
Not at all. We sold quite some time ago. We had a tech business in Russia. Russia is blessed by some of the most by some of the most talented technology individuals, PhDs, researchers, very smart mathematicians, scientists. So there are a number of interesting businesses. By the way, sorry for the helicopter in the background. I'm just sitting next to the Munich Security Conference here, and I think there's a bit of a noise here. Anyway, Russia is, as I said, there are some very, very interesting and talented entrepreneurs, a couple of interesting businesses. There's always, in most cases, some sort of governance issue. And unfortunately, in many ways, these governance issues are very difficult to address. So we sold this earlier last year, as we saw that the situation on the governance side was sort of not really improving. Besides, at this stage, I'm quite happy not to be exposed to this area there. You don't know whether there will be sanctions. I think Russia will take a long time to recover from this period of tension. It's not going to be solved easily. Countries where you have combination of a very good macroeconomic conditions, strong currencies, a very strong general business climate, and political support meeting entrepreneurs. So we don't need to waste our time with situations that are too difficult.
Fair enough. I mean, are there whole countries that you just wouldn't look at because they're just sort of too difficult politically or economically?
That's a good question, and I would say in a way no, because there are always companies which are exciting, and we are, at the end of the day, we are, we enjoy research, we enjoy companies, we enjoy learning from entrepreneurs. So even in some of the most difficult places, you find those people. But if you have the luxury of choosing globally, we will always tend to prefer to invest in those opportunities which are also supported by easier business conditions. So we looked at Pakistan. We had a very interesting, good company there, which we did not invest in because of macro concerns. We looked at the Middle East in some places where also macro or politics was a concern. In China, it's really regulation, which continues to be a major cost and drag to businesses. And then in some of the smaller Latin American markets, similarly. So there is a strong preference in general to spend our research hours on the more exciting, safer places, to be honest.
How do you actually cope with currency volatility?
How do we deal with currency volatility?
Yeah.
Well, it's something you need to deal with. It's something you need to put into your models. It's something you have to have a good understanding of in terms of, a currency is essentially nothing but a reflection of the macroeconomic conditions of a country. It's a function of interest rates. It's a function of confidence. It's a function of the business climate. Therefore, we always sort of, before we invest in a country, we do a deep dive into the macro conditions to understand, how much we expect to make or lose on a currency. To hedge this is rather difficult if you think about financial instruments, because there's really nothing available that gives you long-term protection. There's always short-term instruments which cost a lot, and they don't really give you long-term protection. If you have a 5 to 7 year investment horizon, you better get this right from the beginning. So we try to navigate currencies in such a way that if we invest in a country where there is a risk of depreciating local currencies, we try to defend our investment by investing, for example, in companies that have a diversified revenue streams, also in the hard currencies. That's one way to do this. Otherwise, you have to be very careful because companies themselves also hedge, and you need to understand that very carefully. That can go awfully wrong. We prefer to, again, companies that don't play around with these instruments. So in sum, our portfolio is by and large exposed to currencies where we see a pretty strong and positive outlook.
Here's the top 10. It is quite concentrated, as you say, so more than half in the top 10.
Yeah, it depends on depends whom you talk to. Some people think that you can be even more concentrated, but of course, we know that there are huge benefits of diversification up to a certain point. We typically run positions to 10%. That's the maximum we tolerate. We try to be quite mindful about diversifying across business risks, currency risks, geographical risks, and try to really capture the opportunities that we can find. And as you can see here, it's quite diversified across India, Taiwan, China, which is really via Hong Kong, South Korea, Kenya, Vietnam, and then also industry-wise, there's tech, industrials, healthcare, consumer staples, communications, and consumer discretionaries. What's really important is the sweet spot of the universe. We love companies between 1 and 5 billion. We have all the flexibility we need. So if we find bigger companies, we can invest. But the biggest upside and the biggest value add from our side is also coming mainly from companies which are sort of at a slightly earlier stage of their development.
How do you cope with, or how do you look at valuations? I know that in India, for example, that values sort of ran up quite strongly last year, and sometimes look quite expensive. But do you find a company you love and hold it for the long term, sort of run your winners, or do you keep trimming things if you think they're starting to feel expensive?
Well, we're very structured and rigorous about this. So we always determine a fair value for a business, what we think the fair value should be. Overall, at this point in time, we are not so much in trouble in terms of being too close to the fair values. Number one, because emerging markets are trading at a low point, especially in relative valuations that we've seen the last time in 2008, this sort of opportunity compared to the developed markets. So overall, they are not very highly valued. Number two, we are seeing that we are still in the very early stage of a global recovery from a 2.5-year, 3-year pandemic period that has depressed consumers, that has depressed economic activity in many ways. So into that recovery, we will see that there's going to be a wide spread adjustments of expectations with regards to corporate earnings in emerging markets. We do, as I said, determine very clearly the exit multiples, which is why we did actually sell some businesses in the past. We would also sell if the fundamentals deteriorate. We would also sell if there are any new unforeseen risks that we have to deal with or that we can't deal with. And in terms of the portfolio itself, if you look at the forward multiples, we are looking at single-digit EV/EBITDAs, and we're still looking at very low double-digit PEs for the portfolio overall. So there's plenty of upside here. If you look at the portfolio characteristics overall, as of end of December, market cap is less than £4 billion on average compared to 100 billion for the MSCI emerging markets. We have high profit margins in the portfolio. We have very strong balance sheets with actually net cash, and we have extremely superior profitability with ROEs over 20% and return on assets over 10%. And as I said, we are, if you look at the shorter term multiples, willing to pay, to be flexible. We are not like a value investor per se, but we love to pay up, and even if it's a short-term premium, if we get quality, if we get growth. And in that context, as I said, the valuations are still very reasonable.
We just go back to the previous slide. So what drives the position sizes? Is that done on your sort of confidence in the prospects of these things, or is it just down to performance?
Yeah, so we typically try to start with an equal weighted portfolio. That's always a theoretical exercise. But we always, when we build a new position, we start normally with 0.5% to 1% and try to build it out to 3% at least. And then, of course, as the portfolio is like a living organism, positions change, there's a different performance of individual companies, and that, of course, then has an impact on the overall weight. We try to curate this very carefully to constantly reflect our highest conviction in the respective positions. So yes, what you can see now is that some of those higher weights definitely in our assessment have much higher upside.
Is it true you've got quite high cash in the portfolio at the moment?
No, that was at the end of last year. We sold 2 positions, and that resulted in a strong cash inflow. One was because it reached our target price, the other one I mentioned before. And we've by now been gradually reducing that cash. We've bought a new position, which I cannot talk about now because we're still in the market building out that position. And we've also added to some existing positions. Our aim is to have low cash, but there will always be periods where you have some cash if you need to sell positions or so.
And do you use gearing?
So far, we have been focusing on generating performance, on really working very hard and using our time to ensure that we can run this properly and that we are delivering the right results. Over the pandemic, gearing was not something that could have been negotiated with any bank out there. And it was something which we are allowed to do, and we will consider this for later this year.
Sure. We should spend some time thinking about the ESG aspect, because I think this is a key differentiator for the fund. So I've put up slide 15.
Absolutely. Yeah, absolutely. So, I mean, just briefly on this, and I think there's so much greenwashing going on, and the subject is sort of, I guess, becoming to some investors and market participants almost an irritation. We've been very clear about this from the very beginning. We do recognize, number one, that governance in emerging markets remains absolutely key. We are convinced that local investors, global investors will continue to be more and more sensitive towards the subject and also the ESG and the associated ratings. So if you look at the past 10 years, higher rated ESG companies in emerging markets delivered a very strong outperformance. There's no reason why we should believe that's changing. Also looking at the wider coverage of rating agencies, so far it remains the case that only a very, very small carve out of the universe is being rated. As the rating agencies are expanding their work, we will see more and more of our companies obtaining a rating. So that's why we think it's important to work on this with companies. It's a very important criteria for them to attract new investors, local and international investors. And the outperformance of ESG related factors is, the sensitivities in emerging markets is even stronger than it is in developed markets. So putting this into, sort of our framework, what do we do? We've always focused on governance before the ESG term was even has come into existence. And so we work very closely with companies to help them, to assist them, and to push for these processes which aim to improve their ESG rating, or which are aiming for the companies to obtain their first ESG rating. And we've been quite successful already. In India, in Taiwan, in Korea, we had companies in the last 3 years that obtained their first ESG rating. And that's very, very pleasing. Many of them were also added to sustainability indices. The 4 groups, the 4 segments we look at is environmental areas, where companies begin to report on their environmental footprint. We are looking at social aspects. That's really important in emerging markets. As I said earlier, a lot of the companies, especially during the pandemic, had to invest in social factors, supporting workforce and families. And then governance, which is the biggest area. all the way from transparency reporting, audits, board structure, etc. So that's the biggest area we focus on. We established a website called esgplusc.com. The plus is PLUS. It's a website which aims to disclose and report on the projects which we undergo with companies, and is sort of acting as really a platform where investors, companies, anyone who's interested in emerging markets can see what is happening in this field in emerging markets. And it's sort of a, also a way to circle back to our investee companies so that they can see that, their own shareholders are watching this very, very carefully, what's happening. So we see ourselves as facilitators. We see ourselves as really productive engagement partners of companies, as active shareholders who push for ESG factors to be taken more seriously. We don't invest in companies where we feel that there's no willingness to address any of these factors. We don't invest in companies where we think that governance or governance shortages or problems, for example, are unlikely to improve over time.
Talking about engagement, though, would you buy a company that you thought was a great company, but where something needed sorting out, and then try and agitate to change that, or would you much prefer to buy something that's kind of ready-made, ticks all the boxes?
Well, we definitely put a huge emphasis on the business model, on the attractiveness of products and services, on the operational performance, on profitability, on the competitiveness and the modes of the business. That's always the first attention and where we dig the most. In terms of when we would or would not invest, when it comes to assessing the overall governance structure, there are certain red flags. If we see, for example, a huge imbalance between voting and economic interest, if we see lots of structural conflicts of interest between promoters or controlling shareholders and minority shareholders, and very little scope for us to address this, then this is a real economic risk which we don't want to be exposed to. So we typically invest in brilliant companies which have been very successful in what they do, but which have sort of haven't had maybe the time or the resources to address some of the sensitivities around governance or wider ESG factors. And before we invest, we always have multiple conversations with founders, entrepreneurs, other shareholders, to see what the mindset is and whether they're open to discussing some of those subjects. And in most cases, we get relatively positive feedback. And if that's the case, if we feel, look, we can do something with them, there is room for improvement and there's willingness to do so, then we invest.
Good, thank you. A couple more slides here. So first on the economic outlook, because we've probably got quite a few questions that left over. Firstly, you mentioned US rate rises. So you don't think that is an issue for your portfolio?
Well, higher interest rates is always an issue for everyone out there. So it's definitely something that needs to be well understood and needs to be priced in. Since we are not investing, and it's going to be an issue, especially for countries and companies which are indebted and which have to deal with lots of debt on their balance sheets. If you depend on this, and many of the debt facilities are rather short-term in nature and need to be refinanced, or they're floating rate instruments, so higher rates are always then an issue in terms of cost of doing business and the weighing on margins, and it's also having an impact on the country risk premia, and it's having all sorts of other impacts, including the one where you see flows out of emerging markets into higher yielding instruments in developed markets and the US. Having said that, our portfolio is really driven by very unique business models. They are winners and leaders in certain niches. As I said, they are typically in net cash, so they don't depend on this. They don't depend on refinancing and tapping into the capital markets, debt capital markets. The reason why we invest is not because we think that interest rates will stay low or flat. The reason why we invest is because we think they will do extremely good in any condition, and because they've got a unique set of products or services that's going to be needed in the future. So, for example, we invested in one of the leading businesses in sensor technology, sensors which are needed in all sorts of industrial applications and consumer products. And some of the leading businesses actually sit in Asia. We invested in one of the leading providers of healthcare services in Asia. And again, this is something where we see tremendous upside and strong demand over the coming years. So I would not be too concerned about the higher interest rates in the US. I also don't think they will go out of control. Nobody can afford this, including and mostly the governments over there cannot afford this. So it's going to be within certain limits. But as I said, I'm not too concerned about this. The outlook for emerging market continues to be very compelling. Growth is going to come through. I mentioned India, but also many Southeast Asian economies will report very strong recovery growth rates. Tourism is going to come back. Economic activity is mean reverting and normalizing. Supply chains are normalizing. Inflation rates in emerging markets actually are very, very benign. So the inflation rate, in contrast to the developed world, has been actually almost too low. And in combination with this, we see that as I said earlier, the relative valuations of emerging markets compared to, for example, the S&P 500 are now close to a multi-year low.
Yeah, as we can see there.
Yeah,
definitely. Rising energy prices, is that a factor that you have to worry about?
It's already happening. So, I mean, that's something which is almost a factor of the past. Energy prices have increased quite substantially. We're quite mindful about this in our broad exposure. We look at these sensitivities in the portfolio on a regular basis. So we don't have any specific cluster risk in any of the commodities, and we are also not investing in sort of energy-intensive industries.
So here's your final slide, which is obviously quite optimistic. So you think that the fund's quite set for the future?
Well, I definitely am very optimistic when I think about the long-term prospects of emerging markets. I think the next years will bring a lot of positive results and a lot of earnings growth coming from emerging markets. It's a region which is becoming increasingly stable. Many of the governments are very predictable. Many of the central banks are doing a great job. Many of the currencies have stabilized. The overall public and private sector debt is largely, for the most part, far better looking than it used to be. And then what excites me the most is definitely just the nature of businesses. When you think about the industrial revolutions which are taking place, autonomous driving, metaverse, crypto, in all of these areas, or factory automation, in all of these areas, the components, the solutions, the hardware, the software is coming from emerging markets to a large extent. And also in technology, if you look at semis, many of the new materials, many of the new chipsets, many of the new designs that are needed are coming out of emerging markets. So that's another exciting area, and it's not going to stop. The demand for these products, the expansion of data centers, the expansion of semi content in our day-to-day lives is going to increase exponentially. So that's why we quite agree with these findings that 83% of investors believe EMs are poised for growth. This is also coming from the fact that tourism and travel is going to normalize over the next couple of years, and it's also positive to see that emerging markets are certainly not a crowded trade. If you look at the weightings of institutions and retail investors, they're quite cautious. They haven't really come back. So that's another reason also why they're not so expensive. Most investable EMs in the pandemic recovery, they are all over, whether it's in Asia, of course, especially Asia ex-China, which is exciting, but also in Latin America and Africa, there are lots of opportunities.
Great. I think we agree with that. Thank you very much, Carlos. I think we've run through it's an enormous topic, but we've covered a lot of ground. So we'll probably get you back again in a year or so and see how things are going. But good in the meantime, all the best. Thank you.
Thank you, James. Thanks for having me. All the best.
So thank you to everybody that listened in. We've got our Round the World webinars starting next week, and Matt will be back with you next week talking to Ian Francis, who's the manager of CQS Nutraceutical High Yield. So hopefully the storm isn't too bad for you, and we'll see you next week. Thanks. Bye-bye.